Sensitivity analysis is an outstanding tool to leverage when evaluating the outputs of a mathematical model. It is not as complex and does not have quite the horsepower that, say, a Monte Carlo analysis would give you, but for a simplified evaluation of a few assumptions that you have control over, this is an amazing technique that anyone can leverage. At its core, it is a way to test what-if scenarios at the input assumption level. This can give you a better understanding of what a realistic range of possible outcomes might be for a given situational analysis. This is especially helpful for when underlying assumptions that drive analysis are backed by highly speculative or qualitative insights that do not give us a strong reason to believe one scenario over another. So we want to look at an array of possibilities. This can be useful for financial projections, supply and demand projections, scientific research, environmental models, or even engineering. Now I will run you through a quick example of a simplified personal finance investment forecast to show you the power of sensitivity analysis. You can use one of many online investment compounding growth calculators online for this. I have one linked in the description if you are interested in playing around with it. So first you want to lay out your variables. For this example, we have your initial investment, any monthly contribution, the length of time, your estimated rate, and compounding frequency. For some of these, it makes sense to hold them fixed. Usually it is only good to flex two variables when doing sensitivity analysis. You could do more, but it can overcomplicate things and cloud the interpretation of the results for those that might not understand. So the initial investment is what you have today. Let's use $10,000 as a fixed baseline. For compound frequency, annual compounding is pretty standard, so we can leave that fixed as well. The length of time will depend on your age. So let's say we're 30 now and want to retire at 65, so 35 years. This is one that you can flex up or down if, say, you wanted to retire earlier or felt the need to keep working. But for this example, we really want to focus in on evaluating the sensitivity of the interest rate and monthly contribution assumptions. Interest rate sensitivity makes sense because we never truly know what is going to happen in any given market for any given asset at any given time. So we want to evaluate the range of possible outcomes based on whatever reason there may be to believe one scenario over another. As for monthly contributions, we can evaluate how much we want to cut our expenses so that we can contribute more to investing each month, or maybe if we're feeling pretty confident in our ability to meet our retirement goals, then we can let off the gas a little. So let's run through this. For monthly contribution, let's assume you make around $100,000 a year and bring home, let's say, rounded up about $5,500 a month after taxes for simplicity. For anyone following the 75-15-10 rule, that's 75% to expenses, 15% to investing, and 10% to savings, this clocks us in at around $825 a month that we can or want to invest. For some families, this may seem like a lot if they have kids or elderly family members that they need to take care of, so maybe 10% is more realistic for them. Well, that would bring us to $550 a month to invest. But let's say someone is young and single and wants to see their money grow substantially over time and start with some backward budgeting and invest 50% a month. That would clock them in at $2,250 a month. For expected returns, we can look to a few examples. I like to use 8% as an assumption since I prefer equity investments, and many of those hit around this number, if not more. So it is in the higher end of a conservative range, but could be a fair assumption to use since we have a long-term time horizon like 35 years. Historically, the S&P 500 has averaged around 10% annual growth, so that is a good baseline for upside if we are targeting similar investments. Let's say we want an even more conservative assumption to test, and we use 6.5% since there has been a lot of growth recently, and maybe gains are slower over the next couple of decades. And then finally we can go to our doomsday scenario at 5%, where things kind of just putt along until we want to retire. So with this setup, I would say our anchor assumptions are investing $825 a month and hoping for an 8% return over the long haul. So I generally would start with plugging these in while holding the other variables the same. So that would give us about $1.85 million. Not bad. Then at 10%, it would clock at around $3 million, even better. And with 6.5%, that's $1.3 million, and 5%, about $950,000. So what about our tightened budget scenario at $550? 10% would give us about $2.1 million, 8% $1.3 million, 6.5% would be about $910,000, and 5% about $650,000. Still not a terrible outcome for investing 10% of your income. Then let's look at the super investor scenario for $2,250 a month. 10% would clock in at about $7.6 million, 8% at $4.8 million, 6.5% at about 3.4 million, and 5% at about 2.5 million. As you can see, this tool helps us evaluate a range of possible outcomes for ourselves in any given situational analysis. You can make this as simple or complex as you want, but I would typically recommend keeping it to 3 to 4 inputs per variable to give you between 9 and 16 results to assess so that the outputs are not overwhelming. Once you have the results, you can look at them in silo or aggregate. One aggregate view is to split them into bands. In our example, we have 3 out of 12 results below 1 million, 6 results between 1 and 3 million, and 3 results above 3 million. What remains is your willingness to accept your reasons to believe based on what you can control, your savings rate, and what your risk tolerance is for estimated returns. You can add additional layers to this, like length of investment time within each scenario. This would give you a very clear view of the impact of compounding investment returns. But again, it will only make it more complicated to interpret in the end, at which point you may even want to heat map the results. So that's it. Sensitivity analysis. A super useful tool for evaluating a range of inputs and outputs of a model based on your willingness to believe the underlying assumptions. Work smart, be kind, and help others. Thank you so much if you made it this far. Please consider liking and subscribing for more professional development content, and feel free to comment any questions below. Bye.